The government is mulling setting up a Credit Enhancement and Guarantee Corporation which will guarantee infrastructure bonds. The proposal will go to Cabinet sometime soon. Now, is this a game changer for infrastructure companies? As yet, we don't know much. The credit enhancement provided by the fund can help infrastructure bonds find more buyers. On the other hand, a guarantee can improve rating and attract pension funds to buy out infrastructure projects or invest in them. If banks sell off their completed infra projects, that may make space for more exposures to infrastructure projects on the part of banks. The funding of this corporation is also unclear. The government may put in less than 50% of the corpus, we learn. It's not clear who else will be sought for participation. Will it be funds? Will it be insurance companies? Will it be the retail investor? So the questions we are asking today is, how should an infra guarantee fund be designed? Should it be for under construction projects or for completed projects? How do you get insurance and pension funds, which are patient money, to invest in infra projects? How can retail savings be brought in to invest in infra? And how do you get foreign funds to invest in infra bonds? And can the central government's guaranteeing projects that are vulnerable to state government and other political pressures, will it suffice? Because it seems to be a rather large problem with contingent liabilities for the centre. To answer some or all of these questions, I have with me perhaps people best placed to do that. I have with me former Deputy Governor of the Reserve Bank of India and a commercial banker for 40 years, Mr. SS Mundra. Sunil Srivastava, a former SBI DMD who has headed project financing and infra financing in State Bank when it was practically the biggest lender for infrastructure companies. And may I say my trump card today, Shankar, Raman, the head of finance at L&T, to give us the private sector perspective on how infrastructure financing may be helped by the government. Let me come to you, Mr. Mundra, first, since you wear the regulator's hat, now a private sector hat as well, and a public sector banker's hat. Do you think this corporation, which the government is expecting to be used for credit enhancing and for guaranteeing, do you see it as good for completed projects, or do you see it good enough for under construction projects as well?
Thank you, Latha. Of course, as you yourselves have mentioned, we don't know what is the contour of this proposed corporation or scheme is going to be. But to my mind, if it is confined only to the completed projects, then probably it would not be addressing the need of the day. Because, you know, there are two things to it. Number one, there are already a number of institutions and schemes are available to support the completed projects, where the cash flow visibility has become, where certainty has come. So you have the takeout institution, you had the one which were already in existence for long, the new one which are there. So while it could be a part of it, but today, if we are, thinking about giving a stimulus to the economy and also help the projects which have been installed in various parts, it will be very important if this covers, but rather to my mind, it will be more important if it covers those part of things, so that the new activities are created and which gives the stimulations, which will have the multiplier effect. So that will be a very, very important requirement. And of course, we already have a harmonized list of infrastructure. Within that, what would attract the attention of the private sector, where the money would be prepared to come, that would also be important. But to just to kickstart the discussion and to respond to you, to my mind, it is more important that support comes to the new projects and the projects which are in various stages of implementation.
Okay. It's quite possible that that is the government's plan, because the Prime Minister and the government, various other ministers have been speaking of the investment pipeline, the NIP, and it's possible that this guarantee corporation has been designed to ensure that some of these projects get help in the under construction stage. Now, let me...
Just one point to add to what you mentioned in the beginning. I think it would again not be a good idea to look at this institution as something which will allow the banks to offload their completed book and again enter into the new financing for which they are, I would say they are not bestly suited, both from the perspective of their LM as well as from the viewpoint of their the project assessment capability.
Okay. Yes, sir. The larger question is if we can have bankable projects which can be ring-fenced from the ups and downs of political tempers and political idiosyncrasies, that would be very good. But that's not always successful. So, Mr. Shankar Raman, since you best understand from where the private sector is coming, how can we design a fund that will earn the confidence of insurance, pension and foreign funds, you think?
Thanks, Latha. I think before we address this question, it'll be good to take stock of what ails the sector. I think potential is undisputed. Lots and lots of work to be done in the area of infrastructure asset creation. The quality and quantity of debt that's available and the appetite for equity are the two challenges that the sector faces. In terms of debt, like Mr. Mundra mentioned, I think the biggest contributory today has been the commercial banks, who are not geared actually to have a loan book which runs for 20, 25 years. I think there is a very clear asset liability mismatch in that equation. So we need to find a solution for that. We also have a very poor appetite for private sector infrastructure investment because of possibly the experiences over the last 10, 20 years of putting private funds to work in public space. To my mind, this move of the government can actually resolve many issues. It's a good move, but it's very important that it is thought through very well. To make this work well, I think the credit enhancement has to be broad-based. It can't be very narrow to completed project. It has to be covering all kinds of projects. And secondly, I think the basis of selection has to be very transparent and clear. Today, we may not know it, but as and when we do, it's important that we have a clear guideline on which project qualifies and which project does not qualify. Now, also, we need to develop a very good SOP for administering this enhancement. The way I understand within the limited time that I had to reflect on this topic is it is to enable flow of money to support the project, which means the investors, be it debt or equity, would look at certain prerequisites. These are that they should have the flexibility to exit as and when an opportunity arises or a need arises. It also presupposes that if the cash flow from the project is not sufficient to service the capital, the guarantee would be tapped and the non-funded facility will get converted into funding. And the lenders or the investors' interests would get protected. Now, this does not happen automatically in a government setup. They have their own constraints under which the bureaucracy implements all of these schemes. So there has to be sufficient ring fencing of the cash flows that the underlying asset generates. There must be a mechanism by which it is supervised and a trustee-like structure formed where the interests of the investors are. If there is a surplus after all of this are met, that has to flow through to the equity investors. So the kind of equity investors that this scheme will generate would be really long-term investors. I think liabilities which are lifelong, shorter duration. They have the ALM mismatch on the other side. So if the pension funds and the insurance companies which have patient capital can become the equity investors, and the investment can be not in form of any rigid sponsorship, but units which are tradable, which means both the credit enhanced instruments as well as the underlying equity must be listed for enabling equity. liquidity. So that is when capital will get certain freedom to participate. And later, if the model works out well, the retail investors can hold a piece of India. Today, much of India's classic assets are held by foreign pension funds. The teachers and the municipal workers working in Canada and the United States and Europe are owners of our roads and ports. I think Indian public should have equity in it. And that equity would be enabled if government were to step in and ensure an easy, painless mechanism of servicing the obligation.
Okay. Well, you've laid out the contours very well, Mr. Shankar Raman. But Sunil, I was under the impression that IIFCL would be doing something like that. Looks like it is done only a limited number of projects. Should we not be using an infrastructure that is already existing rather than create another one?
So actually, Latha, you're right, because IIFCL and ADB had issued a partial credit guarantee bond, a project bond for Renew Power, if I'm not mistaken, in 2017, which, they had underwritten 14% each, so 28% of the credit cost had been underwritten. So that was, but that was for a very small issuance of 450 crores, if I remember correctly. But yes, IIFCL is an institution, it needs to be built up. But more importantly, that was at the brownfield stage. It's not in the development or the construction phase. It was post-stabilized.
Okay. Yeah, takeout financing, yes.
The credit enhancement will actually kick in at the credit level or at the revenue level.
Okay.
Now, if you're looking at greenfield projects, what is more important, this will obviously go a long way in assuaging the interest of the investors who have to be coming in with risk appetite for long-term investment. Yeah. But more importantly, you cannot rely on the rating agencies to actually do the rating for such projects. And during the implementation period, IIFCL will perhaps play a greater role in not only assessing and underwriting, but also monitoring the project for any inconsistency and corrections which have to be done immediately. You cannot have projects languishing for years.
One minute, Sunil. Sunil. You are envisaging this Credit Guarantee Corporation. Should we envisage only for credit enhancement? Credit enhancement, and look at guarantee differently for the takeout projects? What should this corporation do? Can it do both enhancement and guarantee under construction and completed? Can one organization do all that?
See, when you're looking at enhancement, you are looking at by way of underwriting the credit partially or fully, or by underwriting the revenue partially or fully. Because when you're looking at infrastructure projects, one thing you kindly remember, that you have to rely only on the cash flows and not on the collateral. And these are long gestation projects.
Yes.
Therefore, the interest of normal investors are not there. And there will be long-term investors who would obviously weigh the risk with your returns. So if you lower the risk, obviously there will be more takers. And the long-term funds will have to come, whether they are PFs or pensions domestically or internationally. But the fact of the matter is they need to have their confidence built up to the fact that the risk mitigated with policies or regulations or any such, you mentioned state and central level differences. Those are mitigated, and maybe these are projected as national projects given the partial credit guarantee from a national institution who will be not only assessing but also monitoring the projects.
Oh, okay. Then you're expecting a very big bureaucracy. Well, I have two separate questions. 1 minute. I have two questions. We already have PFC for power, PFC and REC for power. We have NHAI for roads. All of them also lend. As well, the government's ability to guarantee contingent liabilities are huge. We have contingent liabilities even in terms of funding banks. If one of them fails, that also falls on the fisc. Does the fisc have the capacity to guarantee even more? Those two questions. After the government is thinking of putting up a Credit Enhancement and Guarantee Corporation for infrastructure bonds. This is a proposal that may go to cabinet soon, and to discuss how that corporation should be designed, I have been speaking with Mr. SS Mundra, former Deputy Governor of the Reserve Bank, Sunil Srivastava, former Deputy Managing Director of SBI, and R. Shankar Raman, Director and Chief Financial Officer at Larsen & Toubro. Mr. Mundra, let me come to brass tags. In this fund corporation, the government appears to want to put less than 50%. Who else will put money?
I think as mentioned by Mr. Shankar Raman also about the whole designing and contours of the scheme, and as mentioned by Mr. Srivastava, the mechanism of monitoring. I think if a well laid out plan made which is quite transparent and efficient, where all the components are visible, and this corporation itself could have a clear visible revenue stream, because if they are providing the enhancement and guarantee, of course it will be there would be a revenue from it. If these things are clearly visible, I think there would be investor interest in this, which will not be difficult to come. I would rather say, see, we have to let us look at the larger picture. You know, at this point of time, we know that economy needs a stimulus.
Yes.
We also all realize that in our given situation, investment is the best way of giving that a stimulus. Now, investment, whether government can directly do all the investment and kickstart the economy, that is clearly not on the card. There is the question of fiscal constraint as well as the efficiency of execution. So I think if we put all these things together, this is the best available option. And as I have mentioned, if this it is designed well, I would rather say there could be a corporation entity from the government which is prepared to even put some kind of equity in a project. Then we can very well believe that many of these projects would be coming from the public sector. Of course, there will be private sector also, so that government would also have an interest in the execution of project. And then there is a credit enhancement or guarantee. So it can create a kind of virtuous,
interest
situation,
in the,
where it could be a win-win for everyone.
Okay.
So I would say, yes, I don't think that the investor interest would be one thing if whole thing is designed very clearly and very transparently.
Okay. Sir, I'll tell you where my fear is. Look at the NIIF. We thought it's going to work wonders in 2014. By the time it even broke ground and made its first investments, it was 5 years in. And we are hoping that infrastructure, the NIP, the pipeline, stimulates investments and activity right now. To create another bureaucracy of the kind Mr. Shankar Raman and Mr. Mundra are speaking, I don't know how quickly it can be done. Therefore, on that point, Sunil, we have PFC, REC, NHAI, IIFCL. Do we really need to create another one? Will not that be time consuming? I mean, the PFC has not been able to ensure any discipline of DISCOMs paying on time. They are all government entities. Sovereign guarantee is there. There are similar parties sometime in the center and the states. But where have we been able to ensure that discipline? Another corporation is even how different how much, why should it be more successful?
Latha, to answer your question, the fiscal space is not there and you will need long-term money, which appreciates the risk.
Yes.
You have institutions like PFC and REC, which are sitting on a lot of assets, which some of them are non-performing. The banks have entered this thing and slowly they have also jumped up the learning curve. They have learned from the mistakes, understood the risk. Now, the question is that whether you have the capital to repair the banks or you have the capital to start the investment cycle. In any case, you will require money, long-term money, which is either domestically or internationally. For that, you cannot do it in the private sector. It has to have the support and confidence of some institution in the government, which may be partly owned by the government. It will be also partly owned by the multilateral agencies, to which PFC and REC could provide the debt fund. But you require MES, you require equity, you require long-term funding. And you require, if you're looking at a bond structure, you need to create more players. You need to have a marketability of those bonds as well. So several intermediary steps are to be required. Now, whether it's going to be done in a short time, using an existing institution like PFC, REC or IIFCL, that is a call which the government has to be taken. But now it should not be run by the government as we have faced in the past with NHI and the others, where the bureaucracy will delay things.
Yeah.
So it has to be a partnership where the government support is there, may not be run like a bureaucracy. It can be run professionally. Now, why NIIF has failed, that's another issue which we can debate later on.
Yeah, no, I agree with you. We've just lost connection with Mr. Shankar Raman. We should have him in a jiffy. But Mr. Mundra, very quickly, how can we design it differently from the existing institutions, and how can we do it quickly?
See, that of course, there can't be magic mantra, because in a system and in a government system, obviously, things will move, at their own speed. But yes, learning from all the past experience, looking to the urgency of the situation and the kind of thing, because, we have seen in the past that if there is a will at administration level, then things can be done quickly. It's not always so that they would not do. But I think one of the key things would be the design of ownership. So while it should have all the backing and support of the government, but at the same time, I think
disconnect and connect again.
Ownership.
Let me see whether I'm able to join.
I think so. Ownership will have to be kept in a way which is out of the government ownership. So that would be the way. You can put together a team of experts. One can move quickly. Legal requirements can always be, as I said, if there is a will, these things can be done. And I clearly see that at this point of time, there are not many alternatives, and challenges are not going to go away. So obviously, if this discussion is happening today, it means there is a will. There is a sense of urgency. So let's hope that it works in that direction.
Okay. If I may come in, Latha,
yes.
You can use the existing, the proposed PCG mechanism to actually give some support to the funding agencies like the banks and the PFCs and the RECs.
Okay.
And then once the project is completed, you flip it over into a bond.
Okay.
So till you set up the institution.
Okay.
But this is an urgent requirement, and we need to act on it very fast.
All right. So you're seeing this as guaranteeing the PFCs and the RECs and the NHAIs, but
not fully.
Okay, but
only the
but there is a sovereign guarantee already. One would think. Actually, I'm running out of time. I've lost connection with Mr. Shankar Raman. Shankar Raman, if you can hear me, sir. My point is that there are enough number of sovereign institutions, and PFC is getting all that money or NHAI because of the sovereign guarantee only. It's not that the NHAI has a book of its own in terms of revenues. First of all, do you think another organization is needed, and how should it be different from the current sovereign organizations?
My view is another organization will take long time to set up and staff. So my view is the best way is to leverage on existing organizations that are existing. The guarantee that you're talking about in terms of PFC, etc., are guaranteed by government on their liability side.
Yes.
Now this is shifting to asset side.
Assets.
If the agencies that are existing are going to open a separate line of credit to infrastructure projects, and those credit exposures are guaranteed, then maybe there is extra headroom that gets created for another stream of lending or participation. So it is the same guarantee, but it's spreading from the liability side to the asset side. All that it means is public assets there's no escape for government if they want to have capital come and participate in public assets.
Oh yes, so the fisc will have to be expanded to accept that contingent liability. There is no running away from that, but it will require another discussion to see whether there will be stomach for that in global markets. We are already going to be running at a debt to GDP of probably 75 or 80%, given the lower taxes this year and maybe next. So that finance question also remains unanswered, but we are out of time. Mr. Mundra, Mr. Shankar Raman and Sunil Srivastava, thank you very much for starting this discussion on how we should design a credit enhancement and guarantee corporation for infrastructure.